Good afternoon, everybody. Welcome to Live Valuation. I'm Midas Moriarty. Starting a bit late today. Normally would have started like 2 hours ago. I was kind of going back and forth on whether I actually wanted to do this today. I was kind of a little preoccupied earlier, and then I have other projects that I'm working on that I was tempted to skip today for, but decided to go through with today's stream anyway. Hopefully I can get through it relatively quickly. Should be quick for similar reasons as Wednesday's stream, in that there's just less years of data to work on. However, I do have to type it in manually and calculate things a bit more manually because I can't get the data in a format other than PDF. But regardless of that, we're still gonna go through with today. Now on Wednesday, I had actually mentioned that we were going to be doing Hapag Lloyd. I mistakenly referred to them actually as another Danish shipping company. They're actually a German shipping company. That was a mistake that I realized after the fact, but either way, that is the company we're doing today. They're a more formal ADR rather than the kind of haphazard unsponsored ADR that we did on last Friday, was it? But either way, before getting to that, I was going to say the other project I'm kind of working on that I was kind of considering taking the time to work on instead, since I was already running late today. So I got started on my new spreadsheet template, which I'll be working on probably for the next month or two. Has a whole bunch of empty sheets really so far. It's basically just kind of put together the raw outline of it and then kind of copying elements over from the old spreadsheet template. But each year I usually do a new template, and I kind of began this one a little bit more from scratch than usual. There's a lot of changes I want to do, comments I've gotten from people over the year, as well as just things I already knew that needed to change with it. Also just a slow learning process for myself over time, wanting to get my spreadsheets more in line with the traditional format that you kind of see professionally, both because I am seeking an actual financial profession, as well as I think it'll be more pleasant to look at, as I've described to some people in greater detail. A lot of my spreadsheets are designed for me to work with, not for to be looked at. So when you're watching me work, it probably doesn't make a lot of sense what I'm doing based off of how everything's laid out here. This one page, the summary page, is the only page that I've kind of designed to be presentable, which is why we kind of come here at the very end of the evaluation to kind of go over everything, because it's just designed to look better on this specific page versus all of the other pages where I'm just kind of working on things. But with the new spreadsheet, we hope to change that, where the vast majority of the pages will be presentable with only a couple pages of pure background work kind of going on. And also, you know, each template that I've done each year has also upgraded in a number of actual utility-based ways, making my evaluations more detailed, allowing for more functionality, and there's lots of little things I plan to change as far as that goes. So it's a little bit of a big endeavor. Like I said, it's going to take a few months. I hope to finish by the end of the year, but it might take somewhat into January too. Who knows? I don't really know how long it'll take. Who knows? Maybe I can get it done a lot faster than that. That would be great. But either way, that's just kind of me talking about what I've been working on for the last few days. I might do some streams where I'm working on it live, since a lot of other people have also asked for spreadsheet help and spreadsheet advice, and I've kind of been like, well, I don't really know how to help you and teach you with spreadsheets other than just to do them around you, because in my experience, spreadsheets just kind of have to be done. You're just going to learn by experience. Watching people do spreadsheets doesn't necessarily teach you, because you kind of have to get your hands on the formulas and screw them up over and over again until you figure out how they really work. But I will either way probably be working on this spreadsheet a little bit more live, though, since I'm starting from the ground up, so I can do that. But I am trying to hopefully build a template that I'll actually feel comfortable sharing with people, because I've also been hesitant to share my spreadsheet template with other people, since they wouldn't really know how it works. But I want to make a much more universal template that I think can be shared around more formally. So that's sort of the goal of that project. Anyway, let's get into Hapag Lloyd. Pretty interesting shipping company. We'll see if they present as a better opportunity than perhaps their competitor, sort of competitor that we talked about previously. Don't have calls to listen to for them, unfortunately. Which is why we're just kind of playing music, but I will be relatively quiet while I'm crunching the numbers. Okay. They do report in euros, and I already have the conversion in place, hopefully correctly. I say hopefully because I've notoriously screwed that up many times. Few extra charges down the line. Can't forget those. That is a huge amount of depreciation. Yeah, what did I screw up? What did I screw up? Revenue, cost revenue, personnel minus that, plus that, plus that. Depreciation. Where did I? Interest expenses. Oh, is the other operating result? Is that what I? Is it positive? There we go. Okay, 926.8. That's what it's supposed to be. It had an expense labeled negative next to the other expenses that were listed as a positive, so I assumed that it was a positive cash flow. Whatever, corrected. Change in working capital. No acquisitions. Look at financing. Redemptions. Okay, so they paid out pretty good dividends that year, but that actually matched up with their cash flow. Okay, so they paid a really high dividend in the most recent year. Hard to say that that would continue regularly. The forward dividend, I'm probably just going to assume that the dividend that they actually pay the year prior to that, because that's much more in line with their normal payment. Foreign stocks usually pay dividends with a little bit of a different kind of setup. The tradition surrounding it is just different than American companies. Cool. Just making sure the amount of debt I had over here matched up with the book debt that I had lined up down below. 5136. I've got 5283. Give or take 100 million. I mean, that's book value, so I mean, whatever market value of is, it might actually be closer to what they're actually holding it as, depending on factors. Awesome. The other one doesn't give me the total liability number. And this number is not quite right. This number's not quite right either, but it's really close. What did I screw up? $265.84159.9 2634.4 175.8. What? How is this wrong? Oh, non-controlling interest. I missed this. Thank you. Still off by 0.1. I don't understand. Where's the 0.1 off? Oh, well, it might be a conversion thing. Technically, these things are allowed to be off by a tiny fraction, but either way, the liabilities are definitely off. So current liabilities 3792.9. Okay, so that's correct. Long-term debt. Let's start. 3229.9 plus 940.5. 4170.4. Oh, this might be it. Deferred tax liabilities. Oh, maybe not. $5.5 plus 5 plus 73.1 plus 347.7. It's 461.3. Total equity and shareholders' liabilities are still short by like 30. What am I forgetting? I don't understand what the 0.5. Unless they're accounting for this slightly differently, because that would equal 30 and then it would also equal 0.1. Is this like supposed to be a negative or something? Is that what the... No. Acting as though it should be doubled instead. I don't really see what I've got wrong. Assets 15184.3. That's all correct. Unless they just legit have a discrepancy here. I don't know. Possible. I've found those before. Just there, baby. No, just, oh. I'm trying to stream. I don't know. The only thing I can think of is that there's got to be a discrepancy here. There's no. Looks like this matches up with what they have listed. This matches up with what they have listed. Means the issue has to be here. One of these three numbers. This number is correct. This number is correct. This number I've checked like 15 times. These numbers are all really easy and basic. I don't understand why not matching up correctly. This is 0.1 off for some reason. .1. How is it 0.1 off? It's got to be a discrepancy there, but then that still doesn't answer the liabilities part. The liabilities is like 30 off. That's the part that's really good. It's like, if it was just the 0.1, I would move on from this. I would just say, oh, it's okay. It's a tiny little discrepancy. Those occur. But 30? $30 million? $30 million of discrepancy? I don't know about that. Can't just ignore that. That's why I keep looking at this, because this is just so close. If you doubled this, I think it solves the problem. Or maybe not, but it's close. Because the 31s should be in the liabilities. It's like if you took this out of here and added it to there, I think it sort of fixes the issue. It's weird. Not quite, but I don't know what to do on that. Whatever. We're gonna move on. So I'm not staring at this exact same thing forever. I'm gonna try not to forget about that though. Oh, current assets is slightly too high again. Is it the same issue, or is it actually correct this time? I said I don't mind being 0.1 off. If it's 0.1 off, it could just be a rounding thing. And it's more than that, it gets questionable. Oh, well. How did I just end up with a completely different number? Oh, that's wow. Inventory is 248.5. Accounts receivable 1239.8. I don't know why this one's being so weird for me. Or I'm being weird with it. Something's happening. $361.4. Okay, yeah, but it's still 0.1 off. Interesting. But again, 0.1's fine. I don't mind being 0.1 off. It's when you're 30.1 off. Weird. Also 0.1 off. Like, not gonna lie, this is getting kind of frustrating. Okay, that's definitely correct. Check receivables again. $1,829.4. All right. Fine. 4445.1. Correct. I have to check every single one of these super freaking close because apparently they can't keep their accounting statements straight. looks about right, but can't quite tell. Alright, equity is actually correct. That's cool. Liabilities are apparently $8.50 off for some reason, which is really close to the deferred tax liabilities. Is that what I missed? It's getting really frustrating. Okay, that one might have actually been my fault. Equity is now in line. We're just 0.2 off, which is sort of in line with the other issue we had. So, okay. Whatever. Still a little frustrated by these minor discrepancies, but I guess I'll ignore them. Now the negative expense that was listed as other operating income is flipped to positive, even though I still think it's meant to be the same sign. So they used to do it correctly and then they switched. What is this? These guys. I'm really not a fan of the way they do their accounting. It's like, yeah, okay, I made a mistake or two in here as well, but they are just a mess. It's like, Jesus, are you guys changing your accountants like every year or something? Like, what the hell is happening here? Why can they not keep your numbers straight for like any reasonable length of time? You can't just like keep things consistent for some reason? I don't know. Honestly, getting really frustrated with this company already. Not a very good sales pitch, and I'm not even done looking at their numbers. All right, third balance sheet. And receivables 39 plus 1217.1.7 1256.7. Cool. Inventory is 238.1. Cool. Other assets 300.8 plus derivative instruments 3.6. That's it. 2456.3. Okay, cool. That's accurate. Cool. Non-current assets. $1773.2. Okay, there we go. Just make sure we get these numbers out correctly. Really don't want to come back. Alright, assets are correct. First time. Sweet. Love it. Payables. Whole bunch of other crap, but we got it all together. Cool. Current liabilities are correct. Financial debt, correct. Tax liabilities, simple enough. Okay. Hopefully this comes together correctly. That looks about right, but of course I don't actually know until we get through this, because they didn't give me a total liability line for some reason. All right, wow. That balance sheet was actually 100% clean. Cool. Only 2 more to go as far as our total limited amount of data, since they IPO the ADR, which kind of puts limitations on what I can use, but this is what it is. interesting negative cash, or yeah, negative outflow, or negative net cash outflow, meaning that's actually an inflow from acquisitions, which is a little weird. Negative acquisition costs, which brings their net adjusted capex to a much higher level. Negative net adjusted capex for all 4 of these years, which is pretty interesting. They just received a bunch of cash from that, which is fine because they've been paying down debt too. Then, okay, I think that's right. Right. All right, cool. This balance sheet was clean as well. One more set of financial statements, and we can call it. All right, we'll actually do this sideline next to it. Screw it. All right, cool. Those worked out relatively smoothly. Oh, whoops. All right, now the final balance sheets. See, I'm one off for this for some reason, and I don't see where. All right, assets are correct on this end. And we're one off again over here. Let's see, current assets. Let's just take a look at it. 573.7, that's accurate. Receivables 716.1 plus 31.9. 748, that's accurate. 94.1, that's accurate. 148.5 plus 0.7 equals 149.2. Okay, so it is my fault. Missing this. All right, on to the liabilities. Okay, both of those current liabilities ended up correct. Oh, whoops. Okay. There we go. Finally got through this excruciating process. This is painful. Just gonna forget about the 30 million mystery number there. Pay no attention to that. There's a lot of things we have to change first. The margins are set way too high, so definitely don't get carried away thinking about that one. 17% debt to equity ratio, cost of equity about 6.5%, weighted average cost of capital around 5%. Weighted average interest rate is actually relatively low compared to their debt costs. We could use a longer range average, and that we could perhaps bring it more in line with what would make sense for that. Arguable. Tax rate also kind of disproportionately high because of weird skew of things. 5-year average might help out with that. Not really, but we'll just adjust it ourselves. That makes much more sense. 3-year average for this maybe makes sense. We actually could use a 5-year average perhaps. That would just make it lower over the long run, but that's perhaps a safer set of assumptions. Again, this is all a bit on the screwy side. 3.5 has been the average for the last 3 years, comparative to 2%, which is the average for the last 5 years. So you could argue that they're heading towards 3% average, but that's also perhaps askew. 7% is probably unlikely. It's most recent year average, but you could also technically still argue it. So we'll leave that perhaps as where it is, but we'll probably skew the probabilities pretty dramatically. Probably reasonable to assume that the analysts are assuming the higher range of things. Our returns on invested capital for the last 3 years has been around 7%. We shift it to 5 years, it's more like 5%. 5% again versus weighted average cost of capital that's a little bit above 5%. Probably likely. That makes probably a lot of sense. The interesting thing about this, again, like I said, this is a German company. Their interest rate is that we're using is their 10-year German bond, because the currency is in that. So they do actually have negative interest rates. That means they have a negative perpetual growth rate set for them. So these initial stages of growth is pretty relevant. I do have their Of course, up here you can see their volume versus continued growth over the last few years. They're expecting obviously a little bit of a higher growth rate for the next few years after that to make up for the loss in 2020. A lot of other factors they show here: strong order activity coming down, but at a decreasing rate with an increase from the most recent year. On the backs of the supply chain shortages, a lot of continued backed up activity for the next year or two. As you can see here, for 2021, expected volumes to increase slightly, bunker pricing to increase slightly, freight rates to increase significantly, EBITDA and EBIT expectations here, which we'll think about: 9.2 to 11.2 billion USD, 7.6 to 9.3 billion euros. Pretty dramatic expectation, all considered. I think I will actually leave the revenue expectations relatively even. We're just going to drop this pretty dramatically though. Yeah, so we're pushing up the revenue expectation to a pretty high level as far as this point right here, but we also are weighing back the expectations pretty dramatically. So there's only 5% each for each of these two outcomes, with 40% leaning into the 5% spacing and 30% into 0%. So we do have a heavy percentage leaning into an overall global kind of stagnation potentiality, with some decent potentiality for a significant growth in the future as far as revenues go. And then margins we kind of have in line with that, with a stagnant economy going back to relatively low margins. And if the growth takes off pretty strong, then we'll assume that the margins are going to stay pretty strong as well. So that's sort of the logic we've got going on for this. That brings us to capital expectations, which we haven't even looked at all. Let's see where they'll fall in that. Good for them. They actually do have pretty good capital expectations overall, compared to the super low margins that would be necessary for this to even be a remotely decent investment. The margins are in line with the expectation overall, but unfortunately the capital is not as high as we would hope it to be as far as that goes. So unfortunately that's it's not good enough is basically the outcome. Looking at these as those outliers, and then looking at these as those kind of like stagnant setups, you could say that this is probably too low as far as that worst case scenario goes. It should maybe be like 0.75, but then if I was to do that, I'd argue this is also probably too high, which it doesn't really seem to shift it too much. Overall, the valuation still taking a pretty rough beating. We haven't even adjusted debt. That could be having a huge effect on all of this, because that is a pretty huge amount of debt. So if we change that way, oof, that actually does not help it whatsoever, unfortunately. That's pretty ugly. could argue that maybe this is still a little too high. Really lean into that middle point there, which helps it a bit, but not crazily. We could argue maybe since we pushed the probabilities so far that perhaps this would be a little bit fairer, since this is supremely unlikely. Yeah. Okay. Unfortunately, I don't see a whole lot more that I want to do this. It's just an unfortunate situation. The shipping crisis is probably already just pushed up the price way past what it should be. I mean, after all, like I said, I'm seeing fair value at 55, and only a year ago it was at 50. So obviously, it's taken off rather dramatically this year. So not really a shock. We kind of knew that going into this space in the first place. We're doing these valuations not necessarily for today, but for the eventual crash. But yeah, I don't see too much else I want to do to this other than adjusting for defaults and stuff, which I need to get my tool. Oops, no one. My tool out for that. .33% the most recent year. Okay. So that's pretty much it for Hapag Lloyd. Again, this is the ADR representative of two shares, HPGLY. They're the 10-year treasury for the German bank is today negative 0.176. So that's the risk-free rate that we're using for this investment. The mature market equity risk premium comes to 4.74, and after adjusting for risks, I come to a discount rate for this company of 6.74%, relative to their dividend that they currently pay out, which is a little under 1%. That's based off the dividend from last year because they had a special dividend in the most recent year, so I didn't want to confuse that, so I'm actually basing that off that information. Who knows what they actually do with their future dividends. Either way, 5 years ago they had sales of 9 billion euros. In the most recent year it was 12.7 billion euros, which comes to a 7% growth per year for the last 5 years. The sales to capital ratio of 1.05, which is pretty decent sales overall, but not pretty good compared to the industrial expectation that we come up with them of 1.62. They have returns on invested capital of 5% or so, which is not very exciting, and debt to equity ratio of 16.71%, which gives them a default risk in the most recent year of 1.33%, and then profit margins on average for the last 3 years of 1.9%, which is pretty low compared to their industrial expectations we have for them of 3% or so. So they're a bit low in both categories, which is not very good considering the tentativeness of the balance between those two. Profit in the most recent year of $927 million, which they're selling comparative to today at a price of $107.05, again for the US dollar ADR for this company. For the future, we have a distribution that is tail leaning towards positive outcomes, with a lot of probability leaned towards negative immediate outcomes, and very heavily weighted towards the middle. We come to a revenue expectation of anywhere from 9.8 billion 5 years from now to possibly 25.6 billion 5 years from now. On an expected basis, an approximate 16.2 billion, which is a negative 5% growth to possibly a 15% growth expectation. On an expected value, we come to 4.63% per year. Sales capital ratio, we expect to stay in about the same range, possibly about 1.06, and we expect the returns on invested capital to unfortunately drop to about 4% on an expected basis. We do expect them to perhaps take on more debt during the next 5 years to go up to around 21% perhaps, and that gives them a default risk reasonably high, mostly due to the worst case scenarios of about 2.17% per year. Overall, on a distributed basis, we have a profit margin expectation of 3.24%, when that gets them a profit on a distributed basis of 584 million, but really it's about the kind of the distribution between the outcomes of anywhere from a loss of 100 million to possibly a profit of 2 billion, and the overall spread between those. Based on the discount rate that we have for them, we come to a present value of $60.12 per share, which is 43 to 44% lower than the current price. We have 5-year forward value targets, unadjusted for the dividends that they'd be paying out, of anywhere from $7.31 to possibly a high end of $234.49. On an expected basis, we come to a price expectation of $83.30, again unadjusted for the dividends paid out. Based off the price that they're currently trading for, I would expect an investor today to make 4.89% per year for the next 5 years. Short-term pricing metrics for them, it's meaningless because we don't have an analyst 5-year EPS number, and my value score comes out to be pretty low, in fact negative for them, because of the massively over valued price that they're selling at, mixed with overall bad qualitative fundamentals as far as capital efficiency and operating efficiency goes. So definitely not a very appealing company overall, much like the other Danish shipping company that we had looked at, but I was curious to take a little bit of a look at this industry, especially since some of the indicators from the most recent year of performance made them look really good. I did know that that was kind of a recency year bias, and so I kind of expected these stocks to very likely be overvalued, just because of obviously the sentiment surrounding the industry, that these stocks probably would have been bought up a long time ago. Definitely seems to be the case for both of them, but either way, we took a look at them. They very well might crash once that sentiment changes, so it could be an opportunity for the future. Either way, that's going to do it for us today. I haven't looked again for the last few days to see what it was going to be next on the list, as far as the list of companies that we had been running through slowly but surely. It's like after this one, I can't actually remember what was next, because like I said, most of this week I've been focusing on my my new template project, so that's mostly what I've been thinking about for the last several days. Let's see what it says. DHI. Okay, so that's actually perhaps the next one I was going to look at. I might have to start actually diving into that as soon as I finish this stream. So I will see you all again on Monday, usually around the time the market closes. We had a little bit of a late stream today, but hopefully it won't be a late stream on Monday, and hopefully it will be surrounding DHI. I'll catch you all next time.